Good morning, ladies and gentlemen. On behalf of myself and my team, I'd like to wish you all a warm welcome today. So, let me provide some background as to the theme of our conference today. Last year, 2016, was an extremely volatile year for investors. The FTSE had fallen from 7,100 in April 2015 to 5,700 by mid-February 2016, and it traded at 6,000 at the beginning of June. Now, at the time, 10-year UK gilt yields had fallen to 1.2% as investors sought safe havens. And in Germany, Japan and Switzerland, the 5-year government bond yields were actually trading negative. So effectively, anybody buying into those bonds were prepared to pay the government to look after their money. Now, following Brexit, 10-year gilt yields in the UK actually fell to 0.6%. So there was a lot of concern and a lot of worry. But the second half of 2016 took everybody by surprise, particularly on the political front, where the rise in anti-establishment and nationalism vote, coined populism, suggested greater market uncertainty and a possible recession. But in actual fact, the opposite happened. The UK stock market strengthened on the back of currency devaluation, and Wall Street surged as it pumped out the message of the Trump reflation trade. Into 2017, exchange-traded funds have attracted the biggest inflow of money in the first 2 months of a year on record. $131 billion has been ploughed into these index tracking funds, encouraged by Donald Trump's promises of sweeping tax cuts and large increases in infrastructure spending. So many people are asking a number of questions. Is this market fueling an unsustainable price bubble in the US stock market? And specifically, really, what's changed in the underlying economic fundamentals? Are we on the point of a new phase of sustainable long-term growth globally? Did 2016 mark the end of the deflationary period? And most importantly, are current market valuations justified? Now, just looking at valuations, the US S&P CAPE, which is a cyclically adjusted price earnings ratio, which measures the price of the shares relative to the company earnings per share, is currently trading in the US at 28. And it's only been higher on 2 occasions. One was Black Tuesday, 1929, just ahead of the Wall Street crash. And the second time was 1999, at the dot-com boom and then the bust. The historical average is 16.5. Now, the UK FTSE 100 is actually trading at the moment on a cyclically adjusted PE ratio of 14.3. In 2007, it was 20. Now, the one thing that we do know is that following the banking crisis of 2007/8, which was a deflationary shock comparable with the Great Depression of the 1930s, we've seen unprecedented, globally coordinated central bank intervention to stabilise the monetary system. And at the moment, developed economies continue to be supported by central bank monetary policy. Now, this monetary policy has been labelled financial repression. And basically, it's a series of monetary tools that central banks use. And these include the purchase of government debt, where the central banks create money out of nothing to buy existing assets, which are UK gilts, for example. And they do this to inject liquidity into the banks and to flatten the long-term yield curve, which brings down the cost of borrowing further out in terms of maturity. And they've lowered bank base rates. And the idea behind this is to provide interest servicing relief and to encourage investors to invest in risk assets. So its purpose is to engineer an economic recovery, reflate asset values, and generate price and wage inflation. You could call it a giant price reset to higher levels, thereby reducing the level of private and government debt in real terms. And so far, policymakers have been quite adept at keeping the post-2008 recovery going. In fact, this recovery is now the third longest post-recession recovery since 1945. But there are huge downside risks. Low interest rates penalise savers who are retired and are dependent upon this interest for income in retirement. And government debt has absolutely ballooned. And it's ballooned to levels that place a drag on the economy in terms of sustainable growth. Now, it's quite clear that central banks exert a huge influence on the global economy and effectively our lives.